Good morning. Welcome to today's webinar. This is John McFarland with Miller Johnson's Trust and Estates Practice Group. And today we are going to be discussing charitable gift annuities as part of our Philanthropy and COVID-19 charitable giving series. Last month, my colleague and I, Lori Murphy, discussed the CARES Act and some of the tax incentives in the CARES Act. And our focus last month in our webinar was to discuss ways to make gifts to charity that would have an immediate impact. Today, we are going to focus on charitable gift annuities, which it is really you're planting a seed for tomorrow. It is a gift that you establish now. It's called a planned gift, or sometimes it's referred to as a life income gift. And the charity benefits down the road. It's important, as we have seen with what we're facing as a nation, we're seeing more and more bankruptcy filings. Unemployment has increased significantly. We're facing a healthcare crisis in this country. And charities are also part of what needs to be addressed in terms of making sure they remain solvent, that people who work for nonprofit organizations may continue to do the good work that they're doing to help. There are many healthcare organizations that are nonprofit organizations. So we need to do what we can to make sure that we keep these groups running, doing the good work they're doing, both in the near term and the long term. And that's why today we're going to discuss charitable gift annuities. We're going to go over the following topics today. What is a charitable gift annuity? I think people hear the term annuity and some people have a negative reaction to that. This is not a commercial insurance product or an annuity that you're going to have to worry about commissions or fees or surrender charges. It's a separate instrument that is only available in the nonprofit context. And I'll get into the details. I think sometimes people see that term annuity, and not to say that commercial annuities are inappropriate vehicles. There are times when they are appropriate and they are good to use as part of your financial plan. But I know that some people have a negative connotation or understanding of those. I just want to make sure that you know that's not the case here. It is a gift annuity, and it is something that is unique to the nonprofit world. We'll talk about the benefits of a charitable gift annuity. We'll go over the rates, how they are established, how they're determined. We'll talk about some of the tax benefits of charitable gift annuities. We'll talk about funding charitable gift annuities with appreciated securities. There are some tax deferral opportunities with charitable gift annuities, which make them very attractive. And then we'll talk a little bit about the American Council on Gift Annuities, a great organization. They're the organization that establishes and makes the recommended rates for charities and donors. Very important organization. We'll talk about the deferred charitable gift annuity, which is another type of gift annuity with some unique features. And then finally, we'll touch on state regulation, a brief discussion of the importance of adhering to the regulation of the donor's domicile. So what is a gift annuity? It's pretty simple. It's not anything complex. It's basically a contract. It's a contract between the donor and the charity. And in exchange for an irrevocable gift of cash or securities, the charity will pay the annuitant a lifetime annuity. So it's a nice situation, a win-win for both the charity and the donor, and you'll see why. It is part gift and part annuity, so it's important to look at it that way. It is, you get a deduction, and we'll talk about that, a charitable income tax deduction, for the remainder interest, which passes to charity, the present value of that remainder interest. But a simple vehicle, and if you set one of these up with a charity, you will see most charities have a simple one-page contract that they use when establishing these. So they want to make it simple, straightforward for their donors, and it's not overly complex. And it's a very popular vehicle. I think once donors establish a gift annuity, you see many times they'll establish additional annuities down the road. And from a charity's perspective, it's a great way to build a relationship with a donor and to build trust with that donor, with that ongoing relationship through the contract and through the gift. What are the benefits of a charitable gift annuity? Well, I mentioned already, one great benefit is that income tax deduction. The payment itself, the annuity payment, the payment is fixed and it is not subject to market volatility. And that's one thing that's very attractive to donors who are retired, perhaps in the age range 70 years and up. They are much more attracted to the idea of a stable fixed income. And I always tell clients and potential donors, if you're thinking about a charitable gift annuity and establishing a charitable gift annuity with a nonprofit organization, ask them for a copy of their most recent financial report. You want to look at that balance sheet. You want to make sure that this institution that you're about to contract with is going to remain solvent, that they're going to be able to pay this gift annuity over the course of your lifetime. That's an important thing to think about, and it's not something that you should be afraid to ask the plan giving officer or the chief financial officer of the charity. Just ask them for a balance sheet or for a disclosure statement, which gives you an idea of what their financial situation looks like. There have been, unfortunately, some instances where charities overextended themselves and they issued these contracts and they went under. And then, unfortunately, the annuitant was left with nothing. So that's one important issue I always stress with clients and potential donors. Make sure you get a good feel for the financials of the organization that you're contracting with. We talked about that income tax deduction. You don't get a deduction for the full amount or the fair market value of the securities you transfer or the full amount of the cash that you transfer or give to the charity. For example, if you gave $100,000 to set up a charitable gift annuity, you're not going to get a deduction for $100,000. You will receive a deduction for the present value of the remainder interest that will ultimately pass to charity. And I'll show you some examples here later on in the presentation and explain just exactly how that works. There are capital gains tax savings. I mentioned that. There's an opportunity to defer capital gain, and it can be prorated over the portion of the gain for the annuity itself can be prorated over the lifetime of the annuity. And that can be an attractive feature if you're looking to defer capital gains taxes. There can be estate tax savings. You receive the annuity income for your lifetime, but then the remainder passes to charity. So it's a good way to remove assets from your taxable estate if you have a taxable estate that is not as common as it used to be with the high applicable exclusions that we now have. But it's still something that some of our clients have to face, and so it's an additional feature. These gift annuities are administered by the charity. So you will, many times they'll have an internal office that handles all of the plan gift administration for their nonprofit organization, and they will be the ones who will be working with you, issuing 1099s, helping to set up the contracts, all the accompanying paperwork. They'll be making the payments to you as the annuitant. So as I said, for both the the donor and the charity, it's a good way to build a relationship of trust, and a great way to get to know the organization on a different level many times. The rates are based on the annuitant's age. So the older you are, the higher that payout rate will be. And they look at the life expectancy of the annuitant, and if you have a shorter investment horizon, or you are older, you'll be able to receive that higher payout rate, which is attractive for people who are retired, who like that fixed income. That higher interest rate is a great feature for someone who is 70 plus. You usually see, and it's not always the case, and it doesn't have to be the case, but you tend to see people in that age demographic gravitate towards charitable gift annuities. People who are 70 years and older really like these annuities. The American Council on Gift Annuities that's the organization. It's a nonprofit organization, and the board of the ACGA, it's comprised of leaders in the nonprofit community across the country, and they have a rate committee, and they look at interest rates across the board. They do an actuarial study and will determine what is an appropriate rate for each age of a potential annuitant. And that is important because the goal the ACGA sets forth is to have the residuum be about 50%. So they want to make sure that the charity does end up with a substantial gift, and that you are not putting the nonprofit or the annuitant in a situation where the charity is overextending itself, paying too high of a payout rate. And they have been very, very good with their recommendations, and charities adopt these rates, and it just provides a good source of information for donors and charities when they're establishing and administering their gift annuity programs. These annuities can be 1 or 2 life annuities. So a husband and wife can set one up, a joint and survivor annuity, or it could be just on one individual life. The part of the payment of the annuity income is considered tax-free return of basis. So that's also very attractive. You're not taxed on the entire annuity payment. Only a portion is taxed at the ordinary income rates, and you're getting back tax-free return of basis. And I'll talk a little bit later about the 75/20 rate, and the lower the 75/20 rate, the more tax-free return of basis you will receive. The higher that 75/20 rate, which you use, if it's higher, it's going to produce a larger charitable income tax deduction. So you have the choice of using the current month's Section 75/20 rate, the AFR, which many nonprofits refer to it as the AFR. You can use the current month or the 2 prior months. So to give you an example, May's Section 75/20 rate is 0.8%. That is very, very low. And in March, it was 1.8. So depending on which rate or which 75/20 rate you select, it could have an impact on either the tax return of basis or the charitable income tax deduction. And that's something that when working with donors, clients, it's important to ask that question, because maybe they don't itemize. Maybe they don't care as much about the charitable income tax deduction, and they want more tax-free return of basis, or vice versa. So something to keep in mind there. Again, you get the deductions only for the present value of that remainder interest that goes to charity. If you fund the annuity with appreciated securities, you have the opportunity for the gain to be prorated. So I mentioned that previously, but that's important. If you have some appreciated stock and you want to fund an annuity and spread that gain out, so you're not paying it all at once, that's an attractive feature for a donor. I worked once with a gentleman. I worked for a nonprofit for many years, and there was a gentleman who became a very good friend of mine. He had stock, and he had a company, and through a series of acquisitions, the stock went up substantially. His his cost basis was 7 cents per share. And he came to me and he said, this stock is now trading at $41 per share. So he had a lot of gain that he was facing, and it was concentrated, and he was concerned about market volatility. And we talked about a charitable remainder trust, and we talked about the charitable gift annuity. He opted for the charitable gift annuity. He liked the stability of it. He wanted to get the assets transferred to the charity and out of the market, so he didn't have to face that potential dip with that concentrated portfolio. But he was very happy. He was able to have a partial bypass of that capital gain, which was spread over the life of the annuity, and he received his monthly payments. He had a spouse that had some medical conditions, and the income was really beneficial to him. So there are opportunities out there for plan giving officers, charities, to identify individuals in your donor base that have these types of assets, where these plan gifts and the bypass of gain with the charitable remainder trust, that upfront bypass of gain, or with gift annuities, the partial bypass, it's attractive. So it's important to keep your eyes and ears open when you're listening to donors, and if they mention appreciated assets, I think immediately the thought should be perhaps there's an opportunity to enter into a planned gift. A charitable gift annuity is a planned gift, and it's a very popular vehicle with donors. Here's an example. So this is for a 75-year-old annuitant, and the rate, the ACGA rate for a 75-year-old single rate, is 5.8%. So in this case, the donor would contribute $100,000 in cash to the charity. And in exchange for that gift, or irrevocable gift of cash, that donor will receive an annuity for his or her lifetime of $5,800 each year. You could have quarterly payments, monthly payments, annual payments. That $5,800 is the annual amount, but you can break that down. If you prefer to have a monthly payment, you can have a contract drafted accordingly. Or if you want a quarterly payment, you can do that. The charity will work with you on that for the donor's convenience. That $100,000 cash gift would generate a deduction, if you itemize, of over $43,000. That's a significant deduction. But as you see, as we discussed previously, that's the amount, that's the present value amount of the remainder interest passing to charity. Now, there's a formula that the IRS has in place that determines that amount. But that can be very attractive to someone who needs that income tax deduction. If you're in the 37% bracket, that'd save you over $16,000 in income taxes, which is significant. And you will see many times, if you go through, if you're working for a nonprofit and you have a plan giving office, it's a good idea to take a look at your donor base and see who has named the institution in their trust or their will. If they have let you know as a donor that you are in their trust or will, they are already committed to, not irrevocably committed, but committed in the sense of charitable intent to leave a bequest to the charity. So that might be a good donor to reach out to and inquire about whether they might be interested in a charitable gift annuity. If they're already interested in making that gift after their passing to the charity, they might be interested in receiving an income during their lifetime and then have the remainder pass to charity. So that's something to think about. And it's good for the charity because you are making that gift irrevocable. And so you're locking it in. It's a seed that is planted for the future of the nonprofit organization. So that's important to think about. Again, I mentioned earlier, not all of that annuity payment is going to be taxed at ordinary income rates. Only a portion of it is. So in this example of the $100,000 gift annuity for cash, the $5,800 annual annuity amount, only a portion is taxed at the ordinary income rate, and that's the $1,241.20 you see there in this chart. So that is attractive to a donor who's on a fixed income and they don't want to pay tax on the entire amount. They get a nice, healthy, tax-free amount of over $4,500 there, and that's up until the expiration of their calculated life expectancy. Once they get over that rate or that age, it's all going to be taxed as ordinary income, but still a great benefit for the annuitant. Here's an example, and this is Crescendo Software. This is part of their illustration, but they do a great job. If you have donors and you need to make a presentation, this is just one page of their presentation, but it kind of shows you the flow of how the gift works, the cash gift to the charity, the principal payment or the annuity payment from the principal to the donor over their lifetime, and then ultimately the gift to the charity. But I wanted to show you that. They have really good illustrations. It's a great company. PG Calc is another one that has illustrations that you can prepare for donors, but two good companies that do great work and can put together you can use illustrations to market these gifts to donors. This is for a stock, an annuity funded with appreciated stock. And here you bypass $50,000 in gain, and that could save over $5,000 in capital gains rates for someone who's at that top rate with the 23.8% with that additional 3.8% surcharge. So that's attractive. Again, the deferral over the lifetime, and you can see in this slide again how that breaks down. Some of it's taxed at ordinary income, about $1,200. Some is taxed at the capital gain payout rate of at the 2,278.96 amount, and then the rest is tax-free return of basis. So taxed a little bit differently when you get the 1099. It'll break that out as the annuitant. You'll get that, and you'll use that 1099 for tax reporting purposes. Again, there's the Crescendo slide, just kind of nice, clean way to present this to donors. Their illustrations go into great detail, and you can provide as much or as little as you want when you're presenting these types of plan gifts to donors. This I wanted to show. Now, we talked about the ages. Now, if you're older, you get a better rate. And so you're at 90 years of age, an annuitant could receive 9%, which is attractive. Again, $9,000 per year for a $100,000 gift of cash, and a large deduction. You can see there, you have a shorter life expectancy. So the life expectancy is 5.7 years for a 90-year-old using the annuity life expectancy tables. And so the deduction's higher. $62,000 would be the present value of the remainder interest that's estimated to pass to charity. So, but as a result, the annuitant gets a very large rate. In this case, again, you have a 90-year-old, only $1,278 is taxed at the ordinary income rate. And then the remaining amount is tax-free return of principal, the $7,722. That's tremendous. If you're a 90-year-old and you know you want to help a charity and you need a fixed income, you need a tax deduction, you want the tax-free return of basis paid back, it's a great setup. So And again, if you're in the 37% bracket, over $23,000 potentially saved in taxes. So that's just a great vehicle. And there again is the crescendo slide. This is for a security, an annuity funded with appreciated securities. And here you see again the partial bypass of the gain, which would save $7,398 on the for capital gains taxes. So very attractive features here for these gift annuities. Something to consider, and this question you get a lot, whether you're a plan giving officer or if you're the annuitant. What happens if I die? What if I set up the annuity and I pass away shortly thereafter? Well, it's an irrevocable gift, and the remainder interest will go to charity at that point. So it is something to take into consideration. Now, you can have the annuitant pass away sooner than perhaps was projected, or that annuitant could go on to live many more years. So there's a risk for the charity as well. But in the aggregate, these annuity pools are structured in such a way that the charities end up with tremendous gifts, and any risk is diversified with that annuity pool. But it is important to be upfront if you're working with donors to let them know that that is the case, that if they pass away, that remainder interest is going to go to charity. But there's a great example, Charles Schultz, who's heads up Crescendo Interactive. He tells a great story in his seminars about a charity in Florida that had I think it was a 95-year-old lady who set up a gift annuity. And the plan giving officers thought, oh, this is great. We have a 95-year-old annuitant. And this is pretty much like an outright gift. She's basically going to make an outright gift to us, thinking that she wasn't going to live very long. Well, this particular lady went on to live to be 112 years of age. So they apparently threw a birthday party for her every year at the charity and got a chuckle out of it because she won out. She outlived her calculated life expectancy. So, I mean, that's reassuring too. It's for someone who they need that income and they know that charity will be there for them. So in that particular case, the charity didn't win out, but in the long run, again, and when you look at the aggregates, they do benefit, and it's good for the donors to know they have that security. And again, it builds the relationship with the donor. They feel as though they are being looked after, and they can rely upon that charity to make that payment. And so it really does a good job in building donor relationships. The ACGA, there's the website. Now, I mentioned this earlier. Their website's acga-web.org. You have to type that in. And it's a great website with a lot of materials. They're involved in education, research. They monitor the state regulations. There are many different regulations with each individual state. Some require permits. Some have blanket exemptions. It varies, so you have to keep an eye on those. If you establish a gift annuity program with you're a charity, you need to be mindful of those regulations, because in permit states, they will fine you if you don't adhere to those regulations. And so that could be not good for the charity. The CFO of the charity is not going to like that one bit. So, but the ACGA publishes the maximum suggested rates. I understand they met yesterday, and with this drop in interest rates, the 75/20 rate in May is 0.8%. So they may adjust those rates downward. We're waiting to hear from them. They just met yesterday. So something to think about. There could be a drop in the ACGA rates coming. We'll wait to see. But again, a great organization. And here I have the single life rates. If you go to the ACGA's website, these are just a sampling of different ages, but if you go, you can look at any rate for any age. But as you can see, lower ages produce a lower rate, and then the higher ages, you get the higher rate. There are the 2-life joint survivor ACGA rates. They're a little bit lower because you're dealing with 2 life expectancies, so they drop down. But still, you look at a 90 and 95-year-old, that's 8.8%. That's still very attractive. Assets you can use to fund gift annuities: cash, appreciated securities. I have seen gift annuities funded with real estate. It's up to the charity to decide whether they want to do that, but I've seen it done. And they base the valuation on an appraisal. Sometimes they get 2 appraisals and maybe average it out, or maybe they'll agree to reduce the annuity rate because of the risk the charity takes on when they get an illiquid asset. The CFO for the charity is not going to like that, because they may get stuck paying an annuity with an illiquid asset, and that could put the charity in a frustrating and difficult financial situation. But usually where you'll see this done is where the CFO of the charity knows that property will sell and they'll have liquid proceeds to finance the annuity. For example, I saw this done with farmland with a 90-year-old annuitant. She wanted to give this farmland to the charity, and the charity knew it would sell because it was Iowa farmland and the market was hot, and they had a great relationship with this donor. So they went ahead and did that, and it was a great gift for the charity. So it can be done, but there's a little bit more risk associated with real estate. So if you're a nonprofit executive, you want to be careful there. Make sure you are prudent in how you go about doing that. The deferred charitable gift annuity, it's similar to an immediate gift annuity, but you have to, the payout has to be more than 1 year after the date of funding. So, but the benefit is there are typically higher rates paid out for the deferred charitable gift annuities. So some people use this for retirement planning purposes. They might not need the income now, but 10 years from now, 5 years from now when they retire, they might want that charitable or the annuity payment income. And they might need the deduction immediately. So they can get the immediate income tax deduction during their working years. And then once they retire, they'll have that additional annuity income coming in. So that's a nice variation of the gift annuity that can, for the right donor, could be a good fit. Again, with the state regulation, you just want to be mindful of that. Michigan does not regulate charitable gift annuities. Some states that are pretty aggressive with the fines and regulation: California, Washington, New York. There are many permit states. So you just want to make sure that you work with counsel, whether that's your legal counsel or a plan giving consultant that can help you with that. Again, there are people with Crescendo Interactive and PG Calc that are very knowledgeable and know about the regulation in each state. So important, you don't want to overlook that, because you can get your program in a lot of trouble if you don't adhere to those regulations. So that is the conclusion of the seminar or the webinar today. I just want to thank you all for joining. And if you have questions, let me know. I'd be happy to answer them. Always enjoy talking about plan giving and charitable gift annuities. My contact information is there. Email me or call me. I'd be happy to talk to you. Again, it's a topic that I enjoy and I'm fascinated with it. And there's a great need right now in our country to support charities and encourage charitable giving. So with that, we'll conclude today's webinar, and I thank you for your attention and look forward to future webinars and hope you attend. Thank you very much.